What's up, guys? It is Sterling here from Day Trading Forex Live, and in this video I'm going to go back and we're going to cover our trades from July. So if you're interested in how we track smart money and the process we go through on a daily basis, this is going to give you a good overview of what we're looking at to track smart money, kind of our philosophy, and hopefully, and really regardless of the strategy that you trade, even if you're trading a different strategy, these ideas can help you identify potential reversals in the market, which you might want to notice regardless of the strategy that you're trading. Or if you're not at a point where you don't have a defined strategy, this might be something you consider. So to begin with, I'm a firm believer that looking back at historical setups that nobody took the trade on or nobody called in advance, it's not quite as useful. If a trader, and especially if the educator you're learning from isn't calling these things in advance, you got to ask yourself why. And I think we all know the reason why. It's whether you want to, come to that same conclusion or not. But if they're trying to tell you that something works and they're not calling in advance, that's a problem to me. So let's start with that. First and foremost, we select all these in advance. We term it as the daily market preview, where we have the level pre-selected. Now, there's other pairs that we had on the day. In this case, this was covering multiple pairs, as we do every day. And what we're going to cover is the ones that provided a setup. So to begin with, on July 1st, we were looking for a second push down from 70.05 on the New Zealand dollar. If we go back to the chart, so you can see here 70.05, this is the level that was marked on the chart right there. And we came back into it, because this is a preview for the 1st of July. So here's the 1st of July. We came into it during the New York session. To initiate a stop run for us, we look for, after we've identified the manipulation point or the area we would expect the stop run to occur from, we then look for the confirming entry. Now, as I said, that confirming entry is mechanical. It has pretty basic rules, which are defined by first breaking the level by at least 3 pips or 3% of the ADR, and there's some little nuance to that, but in essence, in this case here, needing a 2-pip break as 3% of the ADR was under that figure. So the bottom line is valid break initiates the level, or initiates a stop run on the level, and then we need a confirming candle. In the case of a short setup, a confirming candle has 2 basic rules. So here's what created the break initially. We'll zoom in. This didn't quite break enough, only broke by about 1.5 pips. This is where you got your full 2-pip break, and then we need what we term as a confirming candle. It closes below the body of the prior candle. So this candle closes below the body of the prior candle, and it closes in its lower 1/3. So essentially just dividing the candle into thirds, it needs to close in that lower 1/3. It very clearly does. At that point, we're waiting for a pullback to what we term as our max stop area. So you'll notice that on this, we also give a max stop 18 pips with dynamic. A lot of things in here I'm not going to be able to fully explain, as I think you guys understand. Otherwise, we'd have a 4-hour video. But in essence, that's our max stop. That means, again, without getting into too much explanation, that means that the entry could be taken 13 pips away from that high or better. Now, we're already in that entry zone. It's only 12 pips away from the high. The entry could have been taken immediately as it was. And this runs off, hits a full take profit. Again, 2-to-1 reward to risk ratios. That's our first trade of the month. Nice 4% trade. And we go into the next setup. So that next one was on July 9th. And as you can see here, this is the text portion of this was put out on July 8th. All these previews are put out at least 7-8 hours in advance of the prior day starting. So on the pound yen, we're looking for a third push down. We're looking for that third push down to occur from 151.69. So there's 151.69. If we go to the chart, we go back to July 9th here, and I'll get rid of a couple of these levels. But there was our 151.69 level. As you can see, we came into it over here. Same situation when it comes to the mechanical entry. Remember, the mechanical entry is well, let me point it out this way. With the manipulation point being pre-selected, with this confirming entry, members know whether or not you had a valid trade. Yes, but number 2, they know, okay, was it a loss or was it a profitable trade? Because that entry is mechanical. So you get the break over here. It finally breaks by over that 3% of the ADR figure. And the next candle confirms down. Again, it closes below the body of the prior candle, and it closes in its lower 1/3. this is a very clear loss. There's no way to spin that other than that's a negative 2% loss. So we're doing everything on a 2-to-1 reward to risk ratio. That's how we work off of, or that's what we work off of. So initial risk of 2%, initial profit of 4%. If the take profit gets hit, 4% gain, as was in the last trade. The stop loss gets hit, negative 2% loss. So 4% on the first one, negative 2 on this, brings us down to plus 2% in the month, and we continue forward. The next trade was on the pound. And we'll go ahead and start by checking the preview as always. So this is the preview for July 14th, and the pair that had the trade was the pound. We're looking for a second push down from 38.51. 38.51 on the charts was right here. So there was our 38.51 level that we had marked. We continue forward. We come into it during the European session. You get your break. So this candle over here, you might be asking, well, why wasn't this a valid stop run and confirmation? Well, the level was 51, and this had a high of 52 and 9/10. So not a 3% of the ADR break. That's why the break initiates here. The next candle does not confirm down. We have 5 candles in this sequence. There's a lot to this entry. Even though it's mechanical, there's other aspects to this. In other words, you can't have 50 candles and then get a confirmation. There's a 5 candle count in this process. So we don't get the confirmation here, but then this next candle does provide the confirmation. It produces a candle that closes below the body of the prior, closes in its lower 1/3. That is what gives us our confirmation. This results in a loss as well, bringing us to break even for the month after that third trade. The next trade was on the pound dollar as well. It's just a few days over. It's over here on the 16th. If we zoom out a little bit, go over to the preview to just show you this level. And as you can see here, by the way, this was just mislabeled. It was the 15th is when it was done, but it was really for the 16th, which is what you see in the charts, just mislabeled in the title there. But anyways, as far as the level goes, 38.01. So here's, 38.02, excuse me. One's about 38.02 is a level, and we had an open bias on the day. So essentially we're trading the outside of kind of some wider manipulation points, but 38.02 was the level going into the 16th. Let's go to the chart, see what happened. Dragging this down to 38.02, that was the level, goes back to a prior point. We get the stop run, we confirm up. So much like a confirming candle in the case of a short that we've been showing you, a long setup has the exact same criteria. You need to break the level by at least 3% of the ADR. Then you need to have a confirming candle, which in the case of a long, just the opposite of a short, it has to close above the body of the prior candle as well as closing in its upper 1/3. This very clearly does both. Provides a valid stop run and confirmation. That was a relatively quick, straightforward take profit as you push to the upside, giving us a full 4% take profit, bringing us back up to 4% on the month. Our next setup goes to the 19th. We had a couple setups on the day, one small loser, one small winner, and that was both on the euro. But to begin with, we had a long on the euro from 17.72, so that was our one lower manipulation point in the day. And then we had a short setup from 18.20. So the market rallied, came into our first upper manipulation point. First lower, only lower that is, and then our first upper manipulation point. So remember those, 17.72, 18.20, going back to the chart. And 72 gets rounded up to this point back over here. We came into this level just prior to, getting closer to the New York session open. We get our stop run, the next candle doesn't confirm, but the candle following that does confirm. That produces our entry. At that point, we have an entry, or we have a chance to take the entry 10 pips from the lows. That gives us a 15 pip stop, 30 pip take profit, the way we do our entries. And then the close on this one here was about 4 pips away from where that entry would have been. So that was marked down as a 0.5% loss. Again, a negative 0.5% loss, taking us to plus 3.5% on the month. And then the secondary trade later in the day was that short from 18.20. So we made this big rally. We came into our first upper manipulation point, which was sitting up here at 18.20. We get the stop run. We don't confirm down. So on this candle here, you can see you get your stop run. You don't confirm down in this candle. This candle closes below the body of the prior candle, but it does not close in the lower 1/3. You can measure that if you like and see, but you can see visually, really, it doesn't close in the lower 1/3. The next candle, again, does not close in the lower 1/3, doesn't close below the body of the prior candle, so it can't be a confirmation. But then this candle here provides the confirmation, gives us our entry, and then we close out at the end of the day for a 2% gain. This one bringing us back up to a plus 5.5% gain on the month so far. Continuing forward in a couple days, we move over to the euro yen. We move over to the euro yen on the 20th of July. And to show you that preview, we'll scroll down here to the pound. This is, again, was the 20th. So you can see here, started on the 19th for the 20th. And we come down to the preview section of this, and we can see that on the there's the pounds. We're looking at the euro yen, looking for a second push down, 129.34. What do we have out in 129.34 on the 20th? We go back to the chart. Here with the level, this is where the level was selected from. We come over to the European session. We get the break. We get a confirmation down. Closes below the body of the prior candle very clearly. Closes in its lower 1/3. Strong setup from there, and a nice full take profit as the market moved to the downside, and again hit that full 4% take profit at that point. That brings us up to a 9.5% gain on the month. We'll go ahead and continue forward to the next setup, which was on the euro a couple days later. And the setup was from one spot 18.20. Nice kind of picturesque stop run confirmation there. But as always, let's go ahead and show the 20th, the preview from the 20th. And by the way, guys, you'll notice that I'm flipping back and forth here. So you'll see some of these are, let me just show you the main page. So when you click on daily market review, you'll see all these pages. Now, obviously there's me, and the one you see in between is Kevin. Now, Kevin is a longtime member of Day Trading Forex Live, who's been trading this strategy for a long time and has now become a proficient trader, a full-time trader using the setup. That's probably one of the most, the things that I'm most proud of with DTFL. It's the people that come out of it and are doing well now as traders. And he's just a great example, and he's now selecting levels as part of the daily market preview 2 times a week. I'm doing it 3 times a week where I do a video. He does text previews and kind of breaks it down that way. But anyways, that's why I go back and forth. And you can see here, this was, again, like I said, on the 22nd. So we'll scroll up here to the 22nd. Actually, that's going to be me. And on that 22nd here, we have a euro short, like I said, 18.20. That was the first upper point we were going to come into for the 22nd. So here's the 22nd. We come into it during the New York session. We get the stop run. We confirm down. Beautiful full take profit trade, taking us from that 9.5% mark to 13.5% on the month. All right, 3 trades left. We're going to go back over to the euro yen. This was on the 26th, and it was a stop run short from 130.25. So here's 130.25. What we're going to do is we'll go back to the preview, show you guys that level. Or sorry, I think I said 25, meant 26. But anyways, like I said, euro yen, 130.25. What I was wrong on there was not the 25th, going into the 26th. So there's our level. That was our upper point. We come into it. We get the stop run. Now you'll notice here that when you do come into it, so here's the 26. Whoops, zoom out a little bit. Here's the 26 coming into it during that New York session. We get the break over here. The next candle doesn't confirm down, doesn't confirm down, doesn't confirm down. Finally, over here, we get the confirmation. That is the way the candle count works. That is the 4th candle in the count. Gives us one more candle to get a pullback. That gives us our entry, and in this case, results in a 1% loss. So 1% loss because we'd close out going into the start of the next session. It's what we term as our session change rule. When you go from New York into Asia the next day, I close out 15 minutes ahead of that session change. At that point, you were down about half of the take profit, or 1% loss, bringing us back down to plus 13.5% on the month. Or sorry, plus 12.5% on the month, excuse me. Second to last trade on the month was on the euro, and it was a euro long on the 28th from the 1804 level. So here's 1804. And if we take a look at that point here, if we take a look at the preview, that is, here's the preview from the 28th. We had the euro dollar looking for that third push up, again, one spot 1804. So we come into it on the 28th. We get the break here. You get an initial break at this point. Now there's something we term as candle count, which adds a little bit of complexity to this. This did not officially break by enough at this point. Where we did get a large enough break was ultimately way over here. This is what breaks it by that 3% of the ADR figure, provides the stop run, confirms up at that point, when it confirms up, the entry could be taken immediately on the open of that next candle. Now this runs, we move to break even at 60% of the take profit. So it moves to roughly 70 or so percent of the take profit. That allowed us to get to break even, comes back later in the day, unfortunately stops us out at break even. But again, protecting that position once you've hit a sizable portion of the profit, in this case, protecting us from a little further downside. So we're still at that 12.5% mark on the month. And we'll go to our last trade, which was a dollar-yen short on the 30th. So going to the preview to wrap up the month, we go in here to the 30th, we'll come up to Kevin's blog for the 30th. Dollar-yen, 109.59, and that was the level right there, was going to be the first lower point on the day. And going back to the chart, what did we have on that? Well, 109.59 when we came into it on the 30th. We come into it just out of the European session, so here's the European session start. Come into it slightly after that, we get the break. We don't get a confirmation until all the way over here. Now, there's something called candle count, because you guys might be saying, well, there's been more than 5 candles in that. There's a way to reset the count that is part of that mechanical process. Again, there's different aspects to the confirming entry and the mechanical rules of it that this video would be 2 hours long if I break down every one of them. The main primary aspect here is that it was a valid trade, valid setup within that 5 candle count, how we define that 5 candle count. And unfortunately, in this setup, produced a loss, bringing us to a month-end total of 10.5%. Now, what I want to really illustrate with this is the potential here. So many people look for way more trades in a month. They risk a way higher figure on any given trade that they're placing. And they have a goal of winning just significantly more trades than is likely. So that's why I say the best kind of starting point is those 4 metrics. 1, shoot for a 2% risk per trade. Don't shoot for it. Use a 2% risk per trade. Number 2, look to take 10 trades in a given month. Maybe you take more, maybe you take less. That's a good starting point. Don't try to force 50 trades in a month. It's just not necessary, and I'm going to show you why here in a second. Number 3 and number 4, to me, probably the most important. 3 is have a goal of winning 50% of your trades. I know that sounds crazy, but to a lot of people, I should say. But some of the best traders I know win 50% of their trades, or around that figure. That is a very common figure, 50, 55, 60%. Anywhere in that range, you're going to do extremely well if you follow that 4th point, which is a 2-to-1 reward to risk ratio. So what does that look like? Well, if you take 10 trades, it's just real simple math here. If you take 10 trades, each one has a 2% risk to begin with, and you're on a 2-to-1 reward risk ratio, well, if you're winning 50% of them, 5 trades times 2% is times negative 2% is a negative 10% loss on your 5 losers. And you're making 4% on your winners if you're on a 2-to-1 reward to risk ratio. So now you're looking at a 20% gain on those 5 winners, giving you an accumulative gain of 10% per month. Now here's the key to that, guys. Compounding those gains over time. So what I'm showing you here is, I don't know what this site is. It's just a compounding calculator that's very easy. So the point I want to get across to you is, what do compounded gains look like over an extended period of time? Because that's how you're going to get what you want. You're not going to get what you want in trading by a month of really high-end, just big days, day after day after day. It's not how it works. What happens when you have those big days, you will also have equally as large, often 3, 4, 5 times larger drawdowns. Instead, by starting with we're going to start with a $10,000 balance in this case. Use that 10% figure that we just talked about, the 10% figure that we actually had from the month-end reviews. Again, the month-end reviews are just covering 2 pairs. What if you're trading 8 pairs? So shooting to the low side here intentionally. Now we're going to spread this out over 48 months. So we're going to spread it out over 4 years. What does that look like? Well, actually, let's go to 5, and then we'll just walk through that. Now what you can see here is at the end of 12 months, you're looking roughly at about a $3,000 gain on that figure, but the $10,000 account growing to just over $30,000. Now, at the end of 2 years, where are you at? Just shy of $100,000. At the end of 3 years, again, where are you at? Just shy of that 309 mark. if in your mind you're sitting there going, man, 10% in a month, I have $1,000 account to start with. Yeah, it's going to take you some time. I wish there was a better answer to that. I mean, I could give you the classic YouTube, you can turn $1,000 into $1 million, but by now you know that's just not true. So what I would ask you to do is to really kind of change your perspective. Very often people are more than happy to go to college for 4 years, come out of college with a debt of 50, 60, 70, 100 grand, and then look for a job making 60, 70, 80 grand a year over a 4-year period of time. So you're coming out of college with debt, with a limited income potential, but yet most Forex traders are saying 4 years, oh hell, I can't wait that long. And they would have a very large account balance sitting on a perfectly compounded account. In this example, just shy of $1 million. And that perspective is too far off. So what I would ask you is to really think about whether that type of perspective is congruent with your current line of thinking. If it's not, you might consider really harping on the consistency and the compounding factor because, again, in 17 years of trading, 12 of those spending it in teaching people how to trade, that is a massive problem people have. So hopefully this gives you guys a good picture of number one, how we trade. Number two, the fact that we are defining this prior to the start of the day. I don't care what educator you go with, make sure they're showing you this stuff live. If they're not, I promise you there's a reason why they're not showing it to you live. But number three, regardless of the strategy that you trade, take to heart those 4 rules. Those 4 rules really are at the heart of every good trader I know. Has maybe a little tweak off those rules, but they follow them very, very closely. That's why I harp on them so much. That's why I preach them in any video I produce. And again, I hope you guys find them useful. So hope you enjoyed the trades. Got a good overview of what we do. If you have any questions, feel free to shoot me an email, support@daytradingforexlive.com. Be happy to answer any questions that you have. If you want to check out our bank trading course, over 15 hours of video, a daily market preview where I'm pre-selecting these levels for you every single day, a live room where we're running every week. That live room gives you a chance to answer any questions you might want answered. We also record that for anybody that can't attend. So again, if you're looking for some type of solid education where you can get this type of direction day in, day out, you might want to check that out as well. But either way, I hope you enjoyed the video, and I'll see you all back for the next one. Until then, happy trading.